In my first year of trading, I ended up losing $12,000 on a single trade. If I made that same trade today, I would have only lost $500. But back then, I had no idea what risk management was. And this is the biggest mistake that I see new traders make. Welcome back to Everything Options. My name is Greg, and today we're going to be talking about risk management. And I know it's not exactly the sexiest topic out there, but it's important that we cover the risks of trading options because you could end up losing a lot of money like I did on Tesla. So first, we're going to talk about the risks that are associated with trading options, and after that, I'm going to show you my risk management strategy that I've developed with some real example trades that I've made over the past month. But before we get into that, if you enjoyed this video or if you learned anything out of it, make sure to show some love, leave a like, and let's get into it. Options trading can be very risky if you don't understand what you're doing. You've probably heard a statistic, something along the lines of 95% of options traders lose money in their first year. And while 69% of statistics on the internet are made up, got him! This definitely rang true for me. And the problem whenever you start trading options is that you're stuck with level 1 options trading, which means that you're stuck with only buying and selling calls or put options. So I got started, like a lot of people do, by buying weekly calls and weekly puts, but instead of relying on my own research and putting in my own time into analyzing these different stocks, I was just following what other traders were doing. But I didn't follow the exits to their trades, which was a huge problem because I always wanted more profits, but I would usually end up taking like 5 or 10% profits on the winners, but then the other half of my trades were losers and I would let those go to zero because when an option expires out of the money, it expires completely worthless and you lose your entire investment. This is why I ended up taking my biggest loss ever on Tesla. I was betting on their stock going up by as much as 50% because of battery day. I thought this was going to be a hit amongst investors and traders. I thought the stock was going to go up a ton, so I bought an out-of-the-money call debit spread. Well, turns out that Tesla actually went down after the battery day, so these options ended up expiring out of the money and completely worthless, so I lost the $12,000 that I invested into these options. Had I used the same risk management strategy that I use today, though, I would have only lost $500 on these options instead of $12,000. So let me share that with you. Now, everybody's risk management system is going to be a little bit different. Most people like to use stop losses of like 10, 20, 50%. So once their option has fallen by that percentage, then they exit out of their trades. But I don't use stop losses at all. With my trading style, I like to set how much money I'm okay with losing up front by setting my maximum loss to $500. But it's not quite that simple because every trade is going to be different. So some trades I'm willing to put up $500 of risk, but other trades I'm only willing to put up $100 of risk, which brings me into my trade grading system. Now this follows your school standard of A, B, C, D, F. Anything that's below a C, it's not even worth trading for me. It's just a bad idea overall. But anything that's above a C, I am willing to trade, and anything that is a C, I'm willing to put up as much as $100, maybe even $200 on the trade. So this isn't a lot of money to me. If I lose $200, I'm probably going to be a little bit upset, but it's not going to be the end of the world. I kind of see these trades as lottery tickets. There's a very low probability of these trades working out, so I'm putting up very little risk to open these options, but they could potentially pay out really big if I'm right on my assumption. And a good example of this has been Maps and their earnings report. Now, Maps had the earnings report, and I had no idea whether their stock would go up or down. But this is a stock that I really like, that I have 1,000 shares of, so I figured might as well put some money down on it, and if it goes well, then I might double my money or more. But if it goes south, then I lose $150. By some miracle of God, Maps actually went up after the earnings report after beating earnings by a ton, and this ended up setting their stock up by 25%. The next day, these options had doubled in value, and I ended up closing out of them, taking 100% profit. And the crowd goes wild. You probably think I'm a genius when, in reality, this was only sheer luck for me. Earnings could have gone completely south and sent the stock tanking even further. These options would have expired out of the money, and I would have lost $150 that I put into this trade, and you'd think I was an idiot. If I kept making these trades and I kept being wrong on them, I would just burn all of my money. If I did these once a week or even once a month, I would lose at least $150 a month, which I wouldn't be okay with. So I use C grade trades very sparingly. Maybe once every 3 months, but not more than that. Again, I see these like lottery tickets, and I don't even play the lotto or gamble at all. But I think these are kind of fun trades to put on, and if I'm right, I get to double my money like I did on maps. My most common trades, though, are going to be B grade trades. So these I have a little bit higher conviction in. I have a little bit more confidence in my analysis for opening these trades than I do with my C grade trades, which are very low confidence. And because I have higher confidence in opening these trades, I'm willing to put up a little bit more risk. So instead of putting 1 or 200 down for the C grade trades, for a B grade trade, I'm putting down $200 to $300 of risk. A good example of this over the past month has been Lucid with their earnings report. Now, I noticed a really common trend where stocks that had really heavy retail involvement would go down 10 or maybe even 20% after the earnings report. But the stock market was going up really well over the last couple of days before Lucid's earnings report. So I was a little bit more neutral than I was bearish. So I ended up opening an out of the money call credit spread with a $32 and a $33 strike price. I ended up getting paid $76 of credit for opening 4 credit spreads, so $19 for each spread. And my maximum risk or my max loss was $326. So if I was wrong about this trade, I would have lost $326, but I was okay with that because I was confident in my analysis with other heavy retail investment stocks going down after the earnings. I ended up being right on this. Lucid fell, I think, like 15% the very next day after the earnings report, just like I expected. And I kind of wish I had put more risk down in order to make more money on this trade, but these are the rules that I set for myself, and I'm not going to break the rules just because I want to make a little bit more money. The only time that I'm okay with losing a little bit more money is if I have very high confidence going into a trade. So for an A score trade, I have my highest conviction or the highest confidence, and I'm willing to put down $500 of risk. And a good example of this over the past month was my SPY Iron Condor. Now, SPY had fallen already like 5% in January, so I figured it probably wouldn't fall much further, so I ended up opening a Iron Condor on SPY, betting on it being between $440 and $470 by mid-February. It turns out that I was wrong on this trade, which goes to show that I'm not actually a genius. I do get trades wrong, which is why I have an 80% win rate instead of a 100% win rate. And I can even fail on my highest confidence trades. But that's why I only put down $500 of risk in order to open this trade instead of $12,000 like I lost on Tesla. And don't get me wrong, $500 is still a lot of money to lose on a single trade. But the thing is, my profits over the last few months has been about $1,000 a month, so usually I can make this $500 back within just a couple weeks. Now, do I wish I had lost less money? Of course, I wish I had only lost $100 instead of $500, but this was a high confidence trade going into it, and it turned out that I was wrong, and I lost my maximum loss of $500, but I'm okay with that. Again, it's going to take me a couple weeks to build back up, and this is about 10% of my options portfolio, so it's not that big of a deal if I lose a single trade. Now, my risk tolerance in these numbers might go up with time as my account grows. So maybe down the line on my A grade trades, I'd be willing to put up $1,000 of risk instead of $500 right now once I have more money to lose. But for now, my C grade trades are going to continue to get $100 to $200 of risk. Again, these are very low confidence, low probability, but high return trades. My B grade trades are going to get a little bit more risk. They have a higher probability of working out, but they're going to offer pretty low returns. And then my A grade trades, I'm willing to put up $500 of risk, so higher risk, but potentially higher rewards with a higher probability trade. Options trading is really all about probabilities and risk and balancing these two things. So, word of advice for new traders: learn about the risks that come with options trading and develop a risk management strategy, and this will help you to become consistently profitable. And you don't have to use the same risk management strategy that I do. This is just an example for you. If you want to use it, go ahead. You can also use stop losses. You can use price analysis. You can use whatever risk management strategy works for you. But if you don't have a risk management strategy in place, then you could end up losing $12,000 or even more, just like I did on Tesla. So hopefully you found this video helpful. Hopefully you learned something out of it. If you did, show some love, leave a like. Thanks for making it all the way to the end, and thank you to all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.